Preparing for a financial analyst at P&G interview, you've reached Candy Mentor and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at P&G? P&G appeals to me because finance is closely connected to real consumer decisions. Its portfolio of trusted brands, global scale, and disciplined operating culture would let me develop strong analytical skills while contributing to pricing, investment, and growth decisions. I also value the company's emphasis on ownership and leadership from day one. I want a role where financial analysis is not just reporting history, but helps teams allocate resources and improve business performance. While answering, connect your interest in financial analysis with P&G's global brands, disciplined management systems, consumer focus, and opportunities to influence commercial decisions through accurate, forward-looking financial insight. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet and starts the cash flow statement. The balance sheet presents assets, liabilities, and equity at a point in time. Cash flow adjusts net income for non-cash items and working capital movements to explain the change in cash. For example, higher inventory may reduce cash even when reported earnings remain strong. Make sure to cover the income statement, balance sheet, and cash flow statement, including net income, working capital, depreciation, retained earnings, cash reconciliation, and why consistency across statements matters. Question 3. How would you analyze sales growth for a P&G brand? I would decompose reported sales growth into volume, pricing, mix, foreign exchange, and acquisitions or divestitures. Then I would compare the brand with category growth and competitors to assess market share performance. I would also examine distribution, promotions, retailer inventory, and price elasticity. A 6% sales increase driven entirely by price may be less durable than 4% growth with healthy volume and share gains. That analysis supports better forecasting and commercial decisions. In your answer, talk about volume, price, mix, foreign exchange, distribution, market share, category growth, promotional intensity, retailer inventory, and whether growth is sustainable rather than purely reported. Question 4. What is the difference between gross margin and operating margin? Gross margin equals sales minus cost of goods sold divided by sales. It reflects pricing, product mix, commodity costs, manufacturing efficiency, and productivity. Operating margin subtracts additional expenses such as advertising, selling costs, research, and overhead, so it captures broader business profitability. At P&G, a brand could improve gross margin through pricing, but see operating margin decline if advertising investment rises significantly. I would analyze both margins before drawing conclusions. Be sure to mention revenue deductions, cost of goods sold, manufacturing economics, operating expenses, selling and marketing investment, overhead, and how each margin helps diagnose different drivers of profitability. Question 5. How would you build a forecast for a P&G product category? I would begin with historical sales, volume, pricing, mix, seasonality, and forecast accuracy. Next, I would incorporate category growth, expected market share, distribution changes, promotions, innovation launches, inflation, and foreign exchange. I would discuss assumptions with marketing, sales, and supply chain partners rather than relying only on a spreadsheet. Finally, I would create base, upside, and downside cases, identify the largest sensitivities, and establish monthly variance reviews to improve the forecast. Focus on historical trends, volume and pricing assumptions, category growth, market share, promotional plans, distribution, seasonality, inflation, foreign exchange, retailer input, and transparent sensitivity analysis. Question 6. Tell me about a time you used data to make a recommendation. In a university consulting project, a retailer was considering expanding a low-margin product line. I cleaned 3 years of sales data, separated volume from promotions, and found that apparent growth came mainly from discounting. I recommended expanding only in stores with stronger repeat purchases and negotiated supplier support. The team adopted the targeted approach, improving projected contribution by approximately 12%. The experience taught me to connect descriptive analysis with an actionable commercial decision. Use a concise star structure, clarify the business question, explain your data validation and analysis, quantify the recommendation, describe stakeholder communication, and state the measurable result or lesson. Question 7. How would you evaluate whether a promotion was successful? I would compare promoted sales with a realistic baseline, not simply the prior period. I would measure incremental volume, net realized price, trade spending, gross margin, contribution profit, and any cannibalization of related products. I would also check retailer inventory and post-promotion demand to distinguish genuine consumption from timing shifts. A promotion that lifts units but destroys contribution may be unsuccessful. Ideally, I would use comparable stores, categories, or historical periods as controls. Mention incremental volume, baseline sales, net price, gross-to-net effects, cannibalization, retailer inventory, trade spending, contribution margin, post-promotion behavior, and comparison with a credible control or benchmark. Question 8. What happens to P&G's financial statements if inventory increases by $10 million? If inventory increases by $10 million because purchases exceed consumption, inventory rises by $10 million on the balance sheet, and cash flow from operations falls by $10 million through working capital. The income statement is initially unchanged because the inventory has not yet been sold or impaired. Later, excess inventory could create storage costs, markdowns, or obsolescence. I would therefore investigate whether the increase reflects planned growth, supply chain timing, or weak demand. Cover the immediate balance sheet and cash flow effects, explain that the income statement is unchanged absent a sale or write-down, and discuss working capital, cash conversion, and inventory risk. Question 9. How do you calculate free cash flow and why is it important? Free cash flow generally represents cash generated by operations after capital expenditures. I would start with operating cash flow and subtract capital spending while reviewing working capital movements and any unusual items. It matters because accounting earnings do not necessarily equal cash available to reinvest or return to shareholders. For P&G, strong free cash flow can fund innovation, capacity investments, dividends, and debt management. I would assess both the level and sustainability of that cash generation. Explain operating cash flow or earnings-based calculation, capital expenditures, working capital, taxes, and why free cash flow supports debt reduction, dividends, reinvestment, acquisitions, and valuation. Question 10. How would rising commodity costs affect a P&G business? Rising commodity costs would initially pressure gross margin, depending on timing and inventory coverage. I would quantify exposure by material, evaluate productivity and sourcing opportunities, and assess whether pricing, pack changes, or mix can offset the increase. I would also consider hedging and competitor actions because passing through costs may reduce volume or share. The key is balancing margin protection with long-term brand health and consumer affordability rather than pursuing price increases mechanically. Be sure to cover gross margin pressure, cost-saving productivity, pricing, mix, reformulation, sourcing, hedging, elasticity, competitive response, timing, and the difference between temporary and structural cost inflation. Question 11. What is working capital and how would you improve it? Working capital includes operating assets and liabilities such as receivables, inventory, and payables. I would monitor days sales outstanding, inventory days, payable days, and the resulting cash conversion cycle. Improvements might come from better demand forecasting, reducing slow-moving inventory, collecting receivables promptly, or negotiating appropriate supplier terms. However, I would not cut inventory blindly. Lower stock can damage customer service and sales. The best solution improves cash without weakening supply reliability. Discuss receivables, inventory, payables, cash conversion cycle, service levels, retailer relationships, forecasting, payment terms, and the trade-off between liquidity improvement and operational resilience. Question 12. How would you assess whether a new product launch is financially attractive? I would build an incremental business case covering expected volume, price, mix, distribution, cannibalization, gross margin, marketing support, launch costs, and working capital needs. I would calculate contribution profit, break-even timing, and returns under base, upside, and downside scenarios. I would also test retailer acceptance and consumer demand assumptions. A launch can be strategically attractive even with modest initial profit, but the economics must show a credible path to scale and avoid damaging existing brands. Focus on incremental revenue, cannibalization, pricing, volume, gross margin, marketing investment, launch costs, working capital, scenario analysis, break-even timing, and strategic fit with the brand portfolio. Question 13. Describe a time you disagreed with a teammate or stakeholder. During a budgeting project, a teammate favored using an aggressive growth assumption because the prior quarter was strong. I listened to the rationale, then showed that the increase was concentrated in a temporary promotion and lacked repeat purchase support. We agreed to use a more conservative base case with a separate upside scenario. The final presentation was stronger because it acknowledged uncertainty. I learned that constructive disagreement works best when focused on assumptions and shared objectives. Show respectful challenge, evidence-based reasoning, listening, alignment on objectives, willingness to revise your view, decisive resolution, and a result that demonstrates collaboration rather than personal victory. Question 14. How do foreign exchange movements affect P&G's results? Foreign exchange affects P&G through transaction exposure and translation of international results into its reporting currency. A weaker local currency can make reported sales and profit decline even when local currency demand is stable. I would separate organic growth from currency effects, review geographic mix, and consider pricing or productivity responses. I would also distinguish hedged transaction impacts from unhedged translation effects. This prevents management from confusing currency volatility with underlying brand performance. Mention translation and transaction exposure, reported versus organic growth, local currency performance, pricing responses, hedging, geographic mix, and the importance of separating operational performance from currency effects. Question 15. What financial metrics would you monitor for a consumer products business? I would monitor organic sales growth, volume, pricing, mix, market share, gross margin, operating margin, advertising effectiveness, free cash flow, and return on invested capital. For consumer products business, I would also track distribution, promotion efficiency, inventory, and retailer service levels. No single metric is sufficient. Strong pricing may conceal volume weakness, while revenue growth may come with poor cash conversion. I would connect operating indicators to financial outcomes and investigate changes against plan. Include organic sales growth, volume, pricing, market share, gross and operating margin, advertising efficiency, cash flow, working capital, return on invested capital, and forecast versus actual performance. Question 16. How would you explain an unfavorable budget variance to a senior manager? I would present the variance as a concise bridge from budget to actual, separating volume, price, mix, cost, foreign exchange, timing, and one-time items. I would explain the root cause and whether it is temporary or likely to continue. Then I would quantify the forecast impact and recommend actions, such as adjusting pricing, spending, or production. I would lead with the conclusion, support it with evidence, and avoid hiding unfavorable information behind excessive detail. Explain variance decomposition, materiality, root cause, timing versus permanent effects, business impact, corrective actions, revised outlook, and concise communication supported by a clear bridge or dashboard. Question 17. What is the difference between accounting profit and economic value creation? Accounting profit measures revenue minus recognized expenses, but economic value creation also considers the cost of capital tied up in the business. A project may increase earnings while destroying value if its return is below the required return for its risk. I would compare incremental operating profit or cash flow with invested capital and the cost of capital. At P&G, growth is most valuable when innovation, brands, and productivity generate returns above that hurdle. Cover accounting earnings, cost of capital, invested capital, returns, opportunity cost, cash generation, and why growth creates value only when returns exceed the resources and risk required. Question 18. How do you ensure accuracy in a financial model or report? I use a repeatable control process, validate source data, reconcile totals to approved reports, separate inputs from formulas, and test key calculations independently. I check signs, units, dates, links, and reasonableness against historical trends. I also use version control and document assumptions so another analyst can reproduce the output. Before sharing, I review the model from a decision-maker's perspective and ask whether the conclusions logically follow from the numbers. Mention source data validation, reconciliations, formula checks, independent reasonableness testing, version control, clear assumptions, review procedures, and documentation that allows another person to reproduce the analysis. Question 19. Tell me about a time you managed multiple deadlines. During an internship, I had a weekly sales report due while supporting a longer-term pricing analysis. I mapped both deadlines, completed data-dependent work first, and created a checklist for recurring report controls. I also told my manager early that one analysis section needed an extra day and proposed an interim version. Both deliverables were completed on time, and the checklist reduced preparation time in later weeks. I learned to communicate capacity before deadlines become risks. Explain prioritization by business impact and deadline, communicate trade-offs early, maintain quality controls, coordinate dependencies, and quantify the outcome or describe what you improved. Question 20. Which P&G leadership behavior best describes you? I identify most with P&G's principle of ownership. In a student investment fund, I noticed inconsistent assumptions across analysts' models and took responsibility for creating a common template and review checklist. I invited feedback, documented definitions, and trained new members to use it. Forecast comparisons became faster and more consistent, improving the quality of our recommendations. As a financial analyst, I would apply the same ownership to data quality, deadlines, and business outcomes. Choose one authentic behavior, provide a specific example, explain the action and measurable result, connect it to finance, and avoid reciting corporate language without demonstrating how you live it. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.